Okay, hello everyone. It's William DeBoyk here again for pipjunkies.com. Today we're going to be talking about why anyone should even consider trading Forex. And that's where we're going to be going from here. Now, a lot of these examples we're going to be doing in the up and coming videos. I'm not sure how many parts there are going to be on these videos just yet, but in the up and coming parts, we're typically going to be comparing why anyone should consider trading Forex versus stocks, futures, whatever the case may be. We briefly mentioned this in the what is Forex videos, but we'll go into a little bit more detail about that in this section now. But in today's video, we're going to be talking about the benefits of Forex itself. We're not going to be comparing this to any other markets for the time being. We're just going to be talking about why anyone should consider Forex as a whole, as opposed to anything else. So we'll jump straight into it and see how we get along. Now, first of all, the main reason why a majority of people do like Forex is the fact that we don't have any commissions. Now, this isn't always necessarily the case. There are some brokers that do charge commissions, but 90%, I'd say maybe even 95%, perhaps even higher than that, most brokers do not charge any commissions at all. Now, the reason why that's a benefit is that if you do place a trade and you get out the trade for break even, if there was a commission on the trade, you still got to pay the broker that commission. So a break even trade actually technically becomes a losing trade because you've had to pay the broker some of the money for the trade, regardless of whether you win or lose. But the majority of Forex brokers, and I'm sure most people here who are listening to this video now, will be using brokers who do not charge commissions. I say there are the odd one that does, and paying commissions isn't always necessarily a bad thing. We'll go into that in more details in later videos, but typically most people will not be paying any commissions whatsoever. Also, as well, the fact that there's no middlemen. A lot of the time with stocks and things like that, you have to go through someone else to actually execute a trade into the market. Whereas with Forex, you can sit at your house, you can place a trade, the trade goes directly from you straight into the market. There's no one else involved, just you in the market. There's no one there in between messing around with anything whatsoever. Not only that, you've also got no fixed lot sizes. This is an interesting one. I mean, basically, a lot size, once again, we'll go into this in more detail, but a lot size is basically the amount of money you can place on any particular trade. Now, with some things, stocks, futures, options, whatever it may be, some of them do have limits. So you have to place trades in increments of $10,000 for argument's sake, okay? Now, with Forex, you can place a trade any amount you like. You can place a trade, for $1,000 worth of currency, $10,000 worth of currency, $10,100 worth of currency, $10,500, $10,600, $10,700.59 worth of currency, just as an example. Basically, it just gives you a lot of freedom. Now, this is also beneficial because you can manage your money better. You can place a trade for a very specific amount, and you know exactly how much you're going to lose if you lose the trade or how much you're going to win if you win the trade. It's very specific, and not only is that a benefit as far as money management is concerned, it also gives, at least in my opinion, a bit of peace of mind as well. But once again, we'll go into more detail about that at a later date. Also, as well, low transaction costs. With any market, you are paying a fee of some sort when you're placing a trade. Okay, it's impossible to avoid. Some brokers will be higher than others for particular transactions, but it's impossible to avoid. Every single broker is going to be charging you something of some sort. But typically with Forex, the fees are very, 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 very low in comparison to other markets. We've already mentioned there's no commissions, and if you're placing a trade, typically you're going to be the spread is what they call it. You're going to be paying virtually nothing on that in comparison to, as say, other markets. So it's always very low for that. Also, as well, as I'm sure we mentioned in the What is Forex videos, you've got a 24-hour market. Okay, so you can place trades 24 hours a day, 5 days a week. Also, as well, no one can call in the market. This is a pretty important thing. I'm sure everyone here at some point has heard, whether it be on the news or whatever, when someone will say, okay, well, the stock market, has been influenced by certain people. Okay, particular market has been influenced by particular people. Now, we've already mentioned in previous videos that the Forex market is worth over $4 trillion a day on average. There's not many people in the world who could, even if they wanted to, corner the market. There's not many people who could influence the market even if they wanted to. Now, this is good because you want to be able to trade in a free market. You want the money to be able to move freely. You don't want one person or an organization to be able to influence things too much. Now, there can be influences. Banks can do certain things. Central banks can do certain things. So the Bank of England, the Federal Bank in America, whatever it may be, they can influence the market slightly, but they can't corner it. Even if they wanted to, they can't corner it. The market's just far too big. It's impossible for one institution, one company, one individual to corner the market. It's physically impossible. They can have short-term effects on the market, sure, but they can't have long-term effects on the market, which is a good thing. So you don't want that. You want the market to be able to flow freely without any interruptions. Also, as well, leverage is a thing here, and leverage can be a good or a bad thing. Now, I'm not sure how much detail we've gone in previously about what leverage is, and I'm sure we'll cover this in a lot more detail in later videos. But leverage basically leverage is what allows you to make your money. Okay. Now, I believe we did mention in previous videos that if you could only trade the money you had, you would not make any money unless you were extremely rich already. Leverage basically allows you to trade more than you have. And I said this can work for and against you. I mean, it allows you to lose more money, it allows you to make more money. But with proper money management, leverage isn't a problem. But with the Forex market, you can get leverage. 1 to 500 isn't uncommon, which basically means that every £1 you have or $1 you have, you can trade up to 500. So if you had $1, you could trade up to $500 in the market. Okay, so it's kind of like going to a casino and they give you a massive credit on the particular money you take in. Luckily, you can only usually lose the money that you have, so you can only lose the $1, but you can trade up to $500. Okay, so leverage is a pretty important thing. A lot of other markets are very low on the leverage side of things. For example, in stocks, it wouldn't be uncommon to see a 1 to 50 leverage, whereas in Forex, as I say, you can easily get 1 to 500. So, it appeals to a lot more people simply due to the fact that they have access to more funds with lower amount of startup capital themselves. Now, it's not always a good thing. Once again, we'll go into this in more detail in a later video, but it's not always a good thing to be underfunded. In fact, it's very rarely a good thing to be underfunded when you're trading. So we'll explain this in more detail, but leverage just allows you to have typically lower startup capital yourself and being able to trade at a decent level. We've also mentioned as well previously high liquidity. High liquidity is what allows us to make our money in any market. If the market's just moving sideways and it's not doing anything, it's impossible to make money. We need the market to be moving up. We need the market to be moving down. We need it to be, all over the place. And liquidity is what allows you to make the money. You need a high liquid market. It allows you to get into the market. It allows you to get out of the market at the price you want. You can get into the price you want. You can get out of the price you want. And, if you've got a nice volatile market, liquidity is very, very important. The last thing you want is to not be able to even get into the market if, you're seeing a trade set up. But with Forex, I can assure you, no one will have a problem with liquidity. And it's always a beneficial thing in the Forex market. Now, our last point on here is free resources. Not only do you get the pipjunkies resources, which are obviously free, but most brokers, in fact, all brokers will have some kind of free resource. Whether it be technical analysis, they'll give you their own analysis, whether it'll be trade ideas, things like this, and software as well. Okay, that most, in fact, all brokers, any decent, reputable broker anyway, will give you free software. They'll give you a demo account, a practice account, a paper account, whatever you want to call it, where you're not risking real money, but you can trade theoretically in real market conditions. You can place trades in certain market conditions, but you don't actually have to place any real money on the line yourselves. And I say a lot of them give you resources. The resources from brokers are not always necessarily the best thing in the world, but it's free, as I say, at the end of the day, so you don't have to worry too much about that. And yeah, that pretty much brings us to the end of this initial video. As I said, there will be more parts, and that's it for now. Any questions, let me know, and if not, enjoy the rest of your day.